Well, let's take a look at some of these footnotes and see what we learn about them. Because there's a lot of interesting things that exist in the footnotes. And the first thing that exists in the footnotes that we want to spend some time looking at is footnote 1, right? This is the summary of significant accounting policies of the company. Very, very important stuff. And the first item that comes up is revenue recognition. Revenue recognition is one of the most critical pieces in any company because if a company wants to inflate their worth, if they want to inflate their income, they can just simply, fabricate revenue or recognize revenue too early. So revenue is one of those things that we've got to pay close attention to and evaluate how they are recognizing it. And what it says here is very simply revenue is recognized when the control of the promised goods or services is transferred to the customers, usually or generally upon shipment of the goods and completion of services in an amount that reflects consideration we expect to receive in exchange for those goods or services. So what that is saying is the customer has to get their stuff. And the risk of loss now needs to pass from this company, Chicago Rivet, to their customer. That's when they can recognize revenue. And there's a lot of other things we have to look at, but that's what you want to be looking for when they are recognized, when they're talking about recognition of revenue. So this is a critical policy. And understanding this and also making sure that it's consistent with generally accepted accounting principles is critical. It's critical. The next item comes down to credit risk. Well, what the heck is credit risk? Well, credit risk is, I'm going to allow my customers to pay me later. I'm extending them some short-term credit. So credit risk is the risk that the customers that I am doing business with fail to pay me. That is credit risk. And so what we want to do is we want to make sure that our customers, the customers that we are allowing to pay us later, are actually have the ability to pay us at some point in time in the future. So it says the company extends credit on the basis of terms that are customary within our markets to various companies doing business primarily in the automotive industry. So think about that. Mostly in the automotive industry. If we are looking right now at what's going on in the world, we've got, are there a lot of people going out there and buying cars? Probably not. So the issue becomes, has this company, if we looked at 2020's financial statements, right? This is 2019. When we look at 2020's financial statements, has their credit risk gone up? Because they are dealing with primarily the automotive industry. That becomes interesting, right? And that may end up causing some issues about their collectability of their receivables. So if we go back to the balance sheet and we take a look at how much they have in accounts receivable, they have $4.6 million to collect in receivables. And as of 2019 and 2018, they only thought out of that 4.6 million or 5.5 million last year, they only thought that 140,000 might not be collected. Based on what's happened this year, and if we looked at their financial statements for 2020, my expectation is that their credit risk has increased and they likely would have a higher reserve for customers that may not pay them back. So looking at these footnotes gives you some insight, right? If you just looked at Chicago Rivet, you say, well, okay, well, they may have some credit risk, but now let's take a look at some of what they're disclosing and how it relates to what's happening in the financial markets, what's happening in the economy right now. Let's take a look at some additional footnotes here. So cash and cash equivalents and certificates of deposit. So they are telling us that all highly liquid investments, including certificates of deposit with a maturity of 3 months or less when purchased, are viewed as cash or cash equivalents. So the fact that, I'm going to go back to the balance sheet, the fact that we have so much in certificates of deposit that are separate from cash and cash equivalents, right? We have cash and cash equivalents of 1.4 million, but 6.5 million are certificates of deposit. So they're buying certificates of deposit that are greater than 3 months in duration when they buy them, right? So this kind of gives us a little bit of idea about how they classify it as a certificate of deposit versus cash and cash equivalents. Here's another thing that we need to focus our attention on a little bit. Fair value of financial instruments, right? Fair value. What the heck is fair value? We're going to chat about that in a little bit. But fair value is another way of accounting. And what we'll find is that there are 3 or 4 different models of accounting that you will come in contact with when you are looking at financial statements. Fair value accounting is one of them. Okay? But we'll talk a little bit more about that. Inventories, another big item on their balance sheet. If we look at inventories, their inventories are almost $5 million. Last year they were $6.1 million. So it's a big number relative to their overall assets of $31 million. So how do they handle inventories? Well, inventories are stated at the lower of cost or net realizable value. What the heck does that mean? And then cost is determined using first in, first out. What the heck does that mean? Our goal for this semester is to try to hopefully explain what some of this stuff is when we start talking about inventories. But net realizable value is a measure, right? That if net realizable value is after I sell it and I have my selling costs and everything like that, if the price of selling it is actually lower than the cost that I bought it for, then I should be recognizing my inventories at the lower of that. So it's conservatism in accounting. You must write down your assets, but there are very limited circumstances where you ever get to write them up. So conservatism in accounting is we want the most conservative viewpoint in certain cases. And then the last one that I want to chat about, which is, we'll talk, there's a couple more. Property, plant, and equipment, right? So properties are stated at cost, right? Some financial instruments are at fair value. So we have fair value, we have cost, and now we have lower of cost or net realizable value. Right, just in this little block, we see 3 different ways of accounting for things on the balance sheet. Fair value, lower of cost or net realizable value, and cost, less depreciation. So it's very interesting in this very short amount of time you have been exposed to 3 different methods. What they mean we'll get into. But I just want to, again, we're just trying to give some clarity, what you should be looking for when you're looking at these things. So property, plant, and equipment, they're stated at cost and are depreciated. What the heck does that mean? Over the estimated useful life using the straight line method for financial reporting purposes. And then there's some other additional discussion around software costs, how they're doing this for income tax purposes. They use a different method for income tax purposes versus financial reporting. That's important. And then how do they capitalize certain things, etc. And then here are the different categories. Land improvements, building. This is their estimated useful life, the range of estimated useful lives. Let's take a look at a couple more real quick, because there's a whole discussion here on income taxes. We'll be brief on that later on, but I do want to have some discussion on that. Segment information. earnings per share, use of estimates. Now, this is a critical piece because there's a lot of areas where they are using estimates, including how long they think something is going to last. What are the depreciable lives of our property, plant, and equipment? That is an estimate. What is my valuation allowance for accounts receivable? That's an estimate. Do I have inventory that needs to be written down to lower of cost or net realizable value because it is obsolete? That's an estimate. So these estimates, there's no proof, right? It's just the judgment based on data that they have that they are going to use these estimates, and those are going to show up in the financial statements. Then we can move on to other footnotes, right? So we have more detail on inventories, right? Think about this. Inventories is $4.951 million, right? We have a valuation reserve of $457. That's for lower of cost or net realizable value. And we have 3 different groups of inventories: raw materials, work in process, and finished goods. And if we think about these inventories, as I am constructing the product at Chicago Rivet and Tool, what I'm doing is I'm buying raw materials, I'm having people manipulate those raw materials, and this is how much is still in process, and then I have finished goods that I have still yet to sell. So this kind of, you're going to see raw materials flow from raw materials inventory to work in process to finished goods, and then out the door, right? Property, plant, and equipment, they do the breakdown. Machinery is by far the biggest piece. But you see that the total amount of property, plant, and equipment, this is at cost. And this is how much of this I've depreciated over the years that I've had it. So of the $46 million that I have in cost, after I depreciate it by $32.7 million, the net property, plant, and equipment is $13.6. Even have a breakout of other accrued expenses. Here's my allowance for doubtful accounts. Here's my inventory valuation reserve, right? So we're giving a little bit more detail on some of these items. Here's our income tax footnote. Lots of interesting things here. We've got current and we've got deferred. We don't know what that deferred means, but we'll talk a little bit more about that. We've got a breakdown of other income. This is interest income off of the CDs, and then just other income that they have. And then they give us breakout of segment information. We've taken a look at this already before. So giving us a little detail about fastener versus assembly equipment. And then, of course, the independent auditors report. So it's just a little bit of an idea about what's going on with this particular company. And if I wanted to take a look at some of these footnotes and kind of go back and see if I can figure out, does any of this stuff tie to the financial statements, I can go and take a look at the segment information, and I can pull out my depreciation right here. Okay, now this is as of December 31st, 2018. My depreciation is $1,308,448. Let's take a look at the cash flow statement and see if that gets close, or maybe it ties out right to the dollar. Let's see. It's pretty close. Depreciation and amortization, it's pretty close. But there's still some that we don't have. And we can always dig a little deeper and find out what that is. But depreciation is $1,308,000. So there must be some additional amortization that we're not picking up in this. But you should be able to, you should be able to tie out or get close with some of the things that you see in the footnotes, right? So for example, $222,000 in deferred income taxes. I can go to my footnote disclosure on income taxes and see that my deferred income tax ties out to $22,000. So in some cases you can get right to it. Other cases it may take a little bit more time.